Good morning, and thank you for being here for the Hedge Investment Credit Fund update. The month of September was quite a tough month for us, but in line with the philosophy and the approach the fund has been taking for the entire of 2022. So we made money on macro up around 1%, a variety of shorts from UK and sterling and long on the treasury side. While on the other side, obviously, we had our idiosyncratic plays suffering because of the lack of liquidity. And we've seen specifically OI suffering by more than 2%, predominantly because of an attempt to renegotiate the price at which the mobile assets were sold from OI to a consortium of telecom company, among others with Telecom Italia Brazil and Telefonica Brazil. Now, we think the arbitrator will be appointed, has been appointed actually, as we speak, and will make a decision in the next 4 or 5 weeks, and we think that decision will be positive for OI. And OI bonds are trading below 30 cents on the dollar, which does really make sense for the liquidity profile or the expectation we have on the business. Let's not forget, OI runs the best fiber optic network in Brazil, and they already attracted private equity money into the infraco, which is being used to deploy the fiber optic. So we feel pretty constructive on the story, and we think the valuation totally warranted at this point, and so we're quite happy to have marked down that position much more than our year-to-date return, and we think it's going to perform pretty strongly in the next future. Away from that, we had a bunch of different idiosyncratic plays, all kind of suffering a little bit with the lack of liquidity, but nothing as notable as OI Brazil. Away from that, in terms of markets positioning and everything else here, we remain quite negative on UK. We think there will be plenty of pressure on the fiscal budget and the dynamics there. We think politically it's going to be not that easy for Liz Truss to do another U-turn after the marginal tax rate, and so we retain a position which is short across a variety of assets in UK. Secondly, we remain negative on asset managers in general, just because the overall QT ongoing and the impact will have on the asset management business. Away from that, we think we are probably reaching a point where central banks may think they've got to at least a temporary or local climax in terms of tightening, and definitely hawkish in terms of verbal hawkishness. So we think there's a chance, obviously, that between now and mid-November we may see the top, both for yields and for hawkishness from central banks, with the pronouncement of ECB, Fed, and Bank of England. We think there's probably a window to actually start buying investment grade or even lower quality fixed income assets into the end of the year after the November. Obviously, the biggest wild card remain by far the events in Ukraine and the impact that has on the entire oil and gas complex. We've seen an OPEC cut of 2 million just in the last couple of days, and we think that that's going to be another push into the commodity complex, but we see the commodity complex overall deflating. We think there is a massive amount of technological deflation still ongoing. So we think there is a chance, obviously, that we may be reaching a fragile equilibrium, and given the seasonality and the liquidity in the market, that could be actually a positive run. Obviously, we remain very negative on a variety of sectors, and we like to run our longs via the special situation that we have in our idiosyncratic plays. But we don't see at the moment a systematic risk just because of the central banks. Obviously, as I said, war can be very bad in terms of escalation, but it can also be very good if we were to reach a ceasefire or a change of direction from Russia. Thank you.